We just had an absolutely crazy month in the stock market. On April 2nd, it was Liberation Day, where President Trump announced global tariffs, and that sent the stock market down big, with the S&P 500 down nearly 12% in the following days. However, now as we start the month of May, we're actually up 0.35% in the S&P 500 from the time that the tariffs were announced. But the month of April had some crazy buying opportunities for stocks with all of the volatility.
We're going to win so much, you may even get tired of winning. And you'll say, please, please, it's too much winning. We can't take it anymore. Mr. President, it's too much. And I'll say, no, it isn't. We have to keep winning. We have to win more.
In fact, during that time, we had the highest volatility in the stock market seen since the March 2020 pandemic sell-off. And prior to that, we had not seen this high of a level since the great financial crisis. If you were investing in the stock market, this month felt like a year. Mr. Market created a lot of buying opportunities, and I took advantage of that to rebalance my portfolio and continue building my portfolio for success in the coming years. I was buying a lot of dividend stocks. That included some big tech dividend growth companies and some high yield dividend stocks with high dividend growth. During the month of April, I bought $35,500 worth of new stocks. But as I mentioned, I also rebalanced a little bit, so I sold $25,000 worth of stocks as well. So net, I invested about $10,000 of new capital. Today, I'm going to break down all of my buys and explain why I made the decisions that I made during the month. On top of that, I'll give an updated look at my long-term dividend growth stock portfolio, which is now currently sitting at an all-time high in total value. And despite the market being crazy so far in 2025, I still have very strong gains in this account, and I feel better now about the future prospects of my portfolio than I have really at any time in the past. Also, since my last portfolio update, I increased my annual dividend income by over $1,000. So if you stick around to the end, I'll take you through all the changes in my account, what are my largest positions now, and what are my largest dividend payers. With that said, let's roll the intro and jump into the analysis. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I'll be using my research tool over on dividenddata.com. If the tool helps you find just one better stock, that way more than pays for itself. You can also track your portfolio and get specific dividend insights that are not shown in many brokerages. If you want to check it out, it's all available at dividenddata.com. The link is in the description and pinned comment of the video. So as I mentioned, my dividend portfolio is currently sitting at an all-time high in total value of $223,000. That's a 59% total return. And if you stick around to the end of the video, I'll give a full update on everything in my account. But right now, I just want to focus on what I bought and what I sold. So here you can see I put together a little spreadsheet to help display this data for you guys. And I'll first start with, what I sold and bought and why. But then afterwards, I'll move into my overarching philosophy of why I decided to sell some stuff at all. And it has a lot to do with the idea of opportunity cost. So let's start with my sells. In total, it came in at $25,920 of stocks. And much of what I sold were things that I considered to be non-core positions and really just smaller holdings in my account. The biggest one that I sold, though, was Apple, ticker symbol AAPL. That was at a total cost of $10,200, and that was my entire Apple position. I sold at a cost per share of $200.09. So it's gone up a little bit since then, but I feel pretty comfortable with that sell overall. This was a very low yield holding of mine with a 0.52% yield on cost, only $53 in annual dividends. But I have had this Apple stock since 2021, and it's done pretty well in terms of gains. And I did offset those capital gains with some other companies I sold at a loss. And I talk about why I sold Apple stock on some videos during the month, but really there were two main factors here. Number one is that Apple's business has not really grown in 3 years, basically. As you can see, since fiscal 2022, the revenue has been around $390 billion. And Apple's annual free cash flow has actually been stuck around $90 to $100 billion for 4 fiscal years now. And it's really Apple's large share repurchases that are a main factor that make it look like the earnings per share is still growing. As you can see, it looks like they had mild earnings per share growth, but that's really just from the share repurchases. So I've been actually saying this for quite a while. I think Apple is the most overvalued of the big tech companies because they have the lowest growth and they trade at a premium multiple. And in hindsight, I probably should have sold Apple stock sometime in 2024 when it was trading at very high prices, like this $259 price in December 2024. That was nuts. But I felt pretty good about that $200 sale price, and I was able to reallocate it in some other companies that have already gone up 10, and in one case, nearly 20% higher. And the reason why Apple's growth has slowed is that the iPhone is over half of their annual revenue and their largest business segment. But the iPhone seems to no longer be a growth business. And in Apple's entire business, it's really their services segment that is the big growth driver in the coming years. And when we look at Apple's business, 75% is hardware. And this actually makes it one of the largest big tech companies who is most directly impacted from the tariff news, which is what sent the stock market down to begin with. And I've talked about this a little bit in my videos during the month, but that is definitely the number 2 reason as why I thought it was a good time to get out of Apple and reallocate to some other big tech companies that were trading at an even better valuation with much higher growth and less risk around tariffs. Apple still has a lot of manufacturing done in China, especially on their iPhone, which is the country most impacted by the tariff trade war. However, there are still just increased tariffs in general, even in countries we're likely going to have some trade deals with, like India and Vietnam. Luckily, Apple has put a lot of work in the past decade in diversifying their supply chain. For example, most iPads, Macs, Apple Watches, and AirPods sold in the US come from Vietnam. And now the majority of iPhones sold in the US are produced in India. However, they still have massive iPhone production in China, and a large percentage of that is sold to the US. So really, there's no doubt that tariffs are going to impact Apple's business, and they likely will have some disruption and change in cost structure from moving their supply chain over time. And there actually was just a report yesterday that Apple is planning to change its release cycle for the next generation of iPhone, delaying the regular iPhone 18 and only releasing the iPhone 18 Pro. And we all know why that is. It's because of tariffs. But I put a little post about this, and I think it was actually a very good move in terms of management of Apple. It delays the timing of some of their future cash flows, but they're more likely now to retain high profit margins. Also, I don't think the consumer will mind at all. The annual iPhone release cycle every single year seems to be getting less and less exciting. And I think if they only have a Pro version and they keep the supply kind of limited and they still kind of market it the same, then it may actually have very strong sales. And that kind of pent-up demand may help with future product releases as well. So overall, I view Apple still as an incredibly high-quality business, one of the best businesses in the world. But when you're managing a portfolio, you don't have to own everything. In fact, you get to pick and choose what you have in your account based on what you think will do well in the coming years. And some of the other decisions I made around this include TROW Price Group, a company I've owned for a couple of years. That's ticker symbol TROW. I sold 76 shares at a cost per share of $86.69. So it has gone up a little bit since then. And I actually think this was a great value if you were looking to get into the stock. However, as I will soon explain when I talk about opportunity cost, I was reallocating to things that I thought were even better opportunities than TROW price at that price. So that gave me about $6,500, and that used to pay me $386 in dividends. And I actually had losses on my TROW price investment. That's another reason why I chose to sell it, because it helped offset some of my Apple capital gains. And the next stock I'll show is another example of that. That's Disney, ticker symbol DIS. This was one of the worst investments I ever made. Ironically, though, I do think it's at a pretty attractive valuation right now, and it will probably do well in the coming years. They've really fixed their financial situation and are poised for likely double-digit earnings per share growth in the coming years. So I sold the entirety of my position. That gave me another $6,500. Again, I took losses on that, offsetting my capital gains from Apple. Finally, this one was a little bit of a rounding error. One of the smallest positions in my account was Automatic Data Processing, ticker symbol ADP. This is a pretty high quality dividend growth stock, but really I just thought that I found better opportunities and it was barely a position at all, so I felt comfortable selling it. So overall, I got $25,000 and got rid of $560 of dividend income. But if we go to my buys, I bought $35,500 worth of stock and actually increased my annual dividend income with those purchases by $1,391. And when we talk about these new buys, I'm pretty pleased with all of them. In my opinion, it's giving me higher yield dividend income, higher dividend growth, and opportunity for higher capital appreciation and total return over the coming years. So I'll start with Alphabet, ticker symbol GOOGL. I bought 66 shares at a cost per share of $149.08. That gave me a total cost of $9,839. This is a low yield dividend company though, $55 of annual dividends from this, 0.56 dividend yield on cost. I've made a number of videos about Alphabet stock, so you guys likely know my thoughts on it, but it's an incredible big tech company trading at an attractive valuation with high growth rates and clear paths to continued high growth in the future. And as you can see, they absolutely just crushed their recent quarter. I made a whole video going over their recent quarterly earnings performance, and it just completely reinforced that they're on a path to continued high growth. Over the trailing 12 months, they're trading at an 18 PE ratio for a company that's reliably growing earnings in the double digits. Here you can see analyst projections for earnings per share growth in the coming years. Here we go, 18%, 6%, 15%, 13%, 22%. If they hit these numbers, they're projected $16.20 of earnings per share in fiscal 2029. And I think that's pretty reasonable that they hit. And based on today's price, that would be a 10 PE ratio. And this is a wildly profitable company with a great balance sheet. So much so that they just started paying a dividend like some other big tech companies like Meta. It's small though, it's less than a 10% payout ratio, and they have a dividend yield of 0.51%. They just announced their first dividend increase, which was 5%. And I think the company is poised for high dividend growth well into the future. And as we look at my overall dividend growth portfolio, Alphabet is now one of my core positions. It's number 4 in the account with a total value of $24,000. Stock number 2 I bought is a very high yield and high dividend growth company, which is MPLX, ticker symbol MPLX. This is a midstream energy company. I bought 2 midstream energy companies this month. So for MPLX, I got 200 shares at a cost per share of $47.44. That's a total cost of $9,488.50. Current annual dividend per share is $3.83, giving me an 8.07% yield on cost and annual dividends of $766. So this stock is a huge boost to my dividend income, which I'm pretty happy about. I think it's also poised to have a strong total return well into the future. And as we take a look at MPLX stock, you can see the price has gone up quite a bit since I bought, and that's pushed the yield down a little bit. They've had very good earnings growth in recent years, but the big story here is with the dividend. This company, even with their high dividend yield, is growing their dividend at a 3-year compound annual growth rate of 10.7% and a 10-year CAGR of 8.84%. And the company's most recent dividend increase was 12.53%. And if you think about that, an 8% yield growing at 12% a year is crazy numbers. And I actually think I bought this with a pretty strong margin of safety where it will have good returns even if dividend growth goes as low as 5 to 7%. That dividend is also sustainable based on the free cash flow generation with a 72% free cash flow payout ratio. And this is a limited partnership similar to Enterprise Partners, which I have had in my portfolio for a while. So if you're thinking about adding this stock, you will get a K-1 tax document around tax season. It's not that complex. You basically just have to check another box and fill out a form. And as I mentioned earlier, this is a midstream oil and gas company, meaning that they focus on the transportation of oil and gas to refineries and other processing plants. And the company is pretty diversified across both crude oil and natural gas, but they are investing more heavily in natural gas since liquefied natural gas is where a lot of the growth opportunities are in energy right now. So here you can basically see a map of how they transport oil and gas and the pipelines that they own along these paths. So every one of these blue lines is a pipeline, and these often go to natural gas processing complexes, refineries by Marathon Petroleum. If you didn't know, Marathon Petroleum owns like 60% of MPLX, and these pipelines basically serve the transportation for that business. They also export at marine facilities on the West Coast in the newly named Gulf of America as well. And they have a huge presence in the Midwest, whether it's Ohio, Michigan, and they also have expanded a lot to Texas in the Permian Basin and on the Gulf Coast. And earlier in this year, I made a few videos going over the energy sector and how I think you should play it during Trump's presidency, since there's going to be a big focus on deregulation and also increasing volume of oil and gas, which will lower the commodity price. I think that the best plays in that sector are not the producers that would be hurt from lower oil and gas prices, but I think one of the best plays in the sector is actually these pipeline transportation companies, because they often have contracts that are not directly correlated with the commodity price of oil and gas. And it's based a lot more on volume and volume agreements. And I'll tell you what, the one thing that I know is going to happen is that volume of oil and natural gas is going to grow. And I also think a big thing in these trade deals coming up will be exporting oil and gas internationally. This company has really only just come on my radar in the past year, and I've started doing a little legwork on it, and I liked the position. And frankly, I wish I knew about it back in 2020 when I was buying a lot of oil and gas stocks, because I could have gotten this easily at a 15% plus dividend yield. And this has also been a sneaky outperformer over the past 5 years with a 5-year total return of 409%. That's from both price increasing and reinvesting dividends over that time. Now, I don't think the next 5 years from this current price will be as high as this, but from my brief analysis, I feel pretty confident that I can get a 10 to 15% annual return at least in the coming years from MPLX. And I'm also going to be doing more stock reviews on this and the other midstream oil and gas company that I mentioned, just so that I can do some legwork and understand the business even better. So the next time there is any oil and gas crash and the price goes to unprofitable levels, I will be ready to pounce. Because if I could redo the year 2020, there's basically 3 or 4 oil and gas stocks I would have bought and probably just gone all in on, and I would have dramatically outperformed. Stock number 3 that I added in the month was HESM. This is another midstream oil and gas company. This is HES Midstream Limited Partnership. I bought 175 shares at a cost per share of $35.91. That's $6,284 of total cost. The current annual dividend per share is $2.84. That gave me a 7.91% dividend yield on cost. And this will pay me $497 in annual dividends. I had talked about this stock once when I was doing an overview of the energy sector earlier this year, but it kind of had fallen off my radar. And once I started buying MPLX, someone in my Discord community actually brought this up again. And then I did a little more research, and I feel pretty comfortable in this and MPLX, so I was kind of diversifying into both of them. But fundamentally, a lot of the same principles apply. They're both pipeline and transportation companies. What I like about HESM is that it has incredibly high dividend growth with a high dividend yield. The 5-year compound annual growth rate of the dividend is 10.49%, and they actually increase it every single quarter. And this is a quarterly dividend, by the way. They just this week announced a 1.23% dividend increase. As you can see, it's anywhere from 1 to nearly 3% every single quarter. And based on free cash flow, this dividend is still very sustainable with a 37% free cash flow payout ratio. And I will be sure to do a full stock review on HESM and MPLX probably in the coming weeks, so stay tuned for that. Hit subscribe if you're not subscribed. And one of the reasons why I felt very comfortable being diversified into this company is that they actually operate in a little bit of a different geographical location compared to MPLX. They are based a lot in the northwest of the United States in the Bakken Basin and Three Forks Shale, also the Williston Basin area. These are somewhat newer to me, but basically it's in the northwest of the United States in North Dakota, South Dakota, and Montana. And much of this was just built out in the past 10 years or so. And similar to how MPLX, they work with Marathon Petroleum, HES Midstream works with the oil and gas company HES. And as you can see, they have a lot of crude oil pipelines, natural gas pipelines, and even water gathering pipelines. And much of the build out is already complete, and they still have continued investments in natural gas coming. And I already mentioned how I think midstream oil and gas is probably our best play given the current energy environment in the United States. But geographically, I really like how this lined up because the new Secretary of the Interior, who's basically one of the people running our energy policy right now in the US, is Doug Burgum, who was the governor of North Dakota. And he played a huge role in basically unlocking and deregulating a lot of that when he was governor, which I'm now kind of putting together is why HES Midstream has now become a bigger player. So geographically, I feel very comfortable about this location doing well in the coming years. And similar to MPLX, I wish I knew about this company back in 2020 because I could have bought this at a 10, 11% dividend yield, even as high as a 20% dividend yield for a period of time. And the 5-year total return on this stock is 269%. But this is why it's important to continue learning and even analyzing stocks if they're not a good buying opportunity yet. That way, when some kind of price volatility happens, you're ready to get in at an attractive price. And even since peak inflation with oil and gas prices, HES Midstream actually has a 54% total return over the past 3 years. And I think this level of performance is probably more likely to happen in the future. And I am okay with that. So those are my 2 big midstream oil and gas companies that are high yield, high dividend growth. And frankly, I'm pretty excited to continue watching these stocks, reinvesting my dividends and adding when they're attractive. For stock number 4, I'm back to the big tech side. I have Salesforce, ticker symbol CRM. I bought 26 shares at a cost per share of $241.65, which is a total cost of $6,282. This is another new dividend payer that I think is poised to be a dividend growth stock in the future, and of course deliver a high total return. The current dividend per share is $1.66. The dividend yield on cost is 0.69%. It will pay me $43 in dividends. And so far, Salesforce has already had strong performance from that price. I really like the price I bought it at. It's now at $275 a share. And frankly, I still think it's attractive at these prices. As you can see, the company has had explosive earnings per share growth over the past few years. And the stock price has largely followed, but it's still very high off from its December 2024 $367 high in share price. This is a subscription software company, and that has led to just fantastic and reliable revenue growth. The 10-year compound annual growth rate of revenue per share is 16%, although this has slowed down with a 3-year CAGR of 12.4%. But I mean, just look at these charts. They're fantastic. This is a very high margin business, 77% gross margin since it's a software company. And really what I like about Salesforce, aside from a lot of other big tech companies, is that they're not directly investing a lot in AI infrastructure. So that means their CapEx is way down, and they get a benefit from everyone else spending their money on CapEx and improving the AI models, which improves all of the software products and offerings over at a company like Salesforce. As you can see, the free cash flow per share at Salesforce has just exploded. The 10-year compound annual growth rate is 26.7%, and the 3-year CAGR is 32.69%. If we look at the annual free cash flow per share, you can see that last year they grew 32% and the year prior 53%. And if we go and look at the cash flow statement, really what we're talking about here is that they have $13 billion in cash from operations, but their CapEx is super low at just around $650 million, which is actually down over the past 5 years. So that means the CapEx will stay constrained and the free cash flow is just going to continue to rise, now up to $12.4 billion. And if we go back to just 2017, that was only $1.7 billion. So that is just a gigantic explosion in profitability. And what do you do with this kind of cash flow? Well, you can return that to shareholders or make acquisitions. And that's why Salesforce has started paying a quarterly dividend and is set to be a dividend growth stock of the future, in my opinion. They already announced their first dividend increase of 4%, and this reinforces that they're at least planning some kind of pattern of annual increases. And based on free cash flow, this payout ratio is super sustainable at around 12%. So I feel incredibly comfortable with Salesforce being a large part of my dividend growth stock portfolio in the coming years now, and frankly, I'll probably continue building this up. It is now my 5th largest holding by total value, actually now ahead of one of my previously largest companies, ExxonMobil. And if we go back to Salesforce here and you see what my cost per share was, I'm already up over 13% on that purchase. And I already have great gains on basically all the stocks I purchased during the month. But a big part of why I reallocated to these holdings is not just about this month, it's about the coming years. And I think these stocks are set to perform well in the future. And going back to that, I have an even better example with Microsoft, ticker symbol MSFT. I bought 7 shares at a cost per share of $360.92. And that's a total cost of $2,526. And yes, I'm already up 20% on that purchase. And it continues building one of my largest positions. Microsoft is the 2nd largest holding in my dividend growth portfolio. Each share is currently a dividend per share of $3.32, 0.92% dividend yield on cost for this purchase, and it will give me $23 of annual dividends. And the reason why the stock went up so much since I bought is they just had earnings and they basically crushed it. Their cloud growth is just fantastic. And I did a full breakdown analysis of the recent Microsoft earnings. So if you want my full thoughts on the company, go watch that video. I'll have it linked below. But in general, Microsoft is just one of the best big tech companies in the world and has a clear path to continued high earnings growth in the future. As you can see, their earnings per share have just boomed, and it's expected to grow at least 10% a year into the future. This is also a reliable dividend growth stock, sustainable payout ratio well below 30%, and the company has been increasing their dividend for decades, and it's reliably at 10% every single year. The 10-year compound annual growth rate of the dividend is 10.35%. Most recent dividend increase was 10.67%. My final stock buy in the month was TPL, which is Texas Pacific Land Corporation, another energy stock, but this is a different one. It's royalty based. I'll probably do a full stock review video on that as well. However, I only bought a little bit because I didn't think it was that great of a deal in the quarter, but I've been slowly trying to build my position. I bought one share at a cost per share of $1,103. I'm already up a good bit on it. This is a low yield company though. The dividend per share is $6.40, but they occasionally have large special dividends as well. Dividend yield on cost is 0.58%, so annual dividends of $6.40. I'll keep it short too with Texas Pacific Land Corporation because it's a small position for me, but this is really high on my target list long term, especially if there's any kind of oil crash. This company is more directly impacted from price fluctuations compared to a pipeline midstream company. But what I love about this company is it's all based on royalties. And compared to oil producers, they really don't have to front really any cash. And basically, the more people they can sign up to drill on their land, their earnings just explode over time. So this is an incredibly high margin business with high earnings growth. And they return a lot of capital to shareholders, as you can see with their dividends. They do these huge special dividends every once in a while, but they also have a quarterly base dividend that they increase on an annual basis. As an example, that base dividend just increased by 36% this past year. And in fiscal 2024, they paid a special dividend of $10 per share. This was another company I wish I had on my radar in 2020 because it sold off a ton and you could have gotten that at 2 to 3% dividend yield based on its base dividend. And the 5-year total return on this stock since then is 740%. Absolutely crushed it. And again, I mentioned this earlier with the pipeline stocks. If I could go back in time, back and redo my 2020, I probably would have had this at least at half of my portfolio at the time. I would have concentrated very heavy on this stock. But I didn't even have it on my radar. I didn't do the research, and you continue learning more and more over time. And I'm sure I'll be saying the same about even more things in the future. So overall, those are all my buys and sells during the month of April, post-Liberation Day sell-off. So now I'll give you an updated look at my overall dividend portfolio, the stocks that make it up, what are my biggest holdings, and also take a look at my projected dividend income. So stick around if you want to see that. But first, I want to mention more about my philosophy for why I made these moves. And frankly, it has a lot to do with the idea of opportunity cost. And I'll provide a clip here from Warren Buffett explaining this idea, since frankly, they can explain it better than I can.
Originally, when I was working with tiny sums, I always had way more ideas than I had money. So I had a portfolio, very limited dollar amount, and I would find something that was more attractive, and which I felt I knew as much about, but was more attractive by a significant margin than something I held. So I would sell something I held to buy something more attractive, never to raise cash. And I was always selling things that were still cheap because it was a market where there were a lot of things that were cheap, and I was looking for the cheapest among things that I understood. Over the years, as more and more capital is accumulated for which I'm responsible, frequently money outruns ideas. I have more money than ideas. So now the only reason I would sell something would be if I lost confidence in the business or the management, or it became dramatically overpriced.
So as we go back and look at my buys and sells, really it all comes down to that idea of opportunity cost. I have a portfolio with a limited amount of money. I don't have unlimited money, but I do have way more ideas than I do money. And we were in this environment of a lot of volatility and things selling off. So I did sell some things that I thought were good values, but I sold those to buy other things that I thought were even better values. And I feel pretty confident that everything I sold, I much would rather have the things I bought. And now when we look at my overall portfolio, I really like the holdings I have. I'm down to 10 stocks in my dividend growth portfolio, with number one being Visa, extremely high quality, extremely reliable payment network, benefits from network effects, high margins, high cash flows, high dividend growth. That's followed up by Microsoft, ticker symbol MSFT. These two combined are nearly half of my dividend growth portfolio. And if you haven't noticed my kind of strategy with investing, I like to go concentrated on my high conviction holdings. For stock number 3, I have the Altria Group, ticker symbol MO. This is my largest high yield position, and I'm doing pretty well with it. I have a 70% total return. Much of this has been built up over the past 3 years. This is my largest dividend payer with $2,320 of annual dividends. And my overall yield on cost, including the shares I've gotten from dividend reinvestment, is now 11.65%. And the Altria Group just a few days ago paid me a $570 dividend. And of course, I reinvested that to get more shares. The fourth largest position is Alphabet, ticker symbol GOOGL. So again, we're back to big tech, extremely high quality business, growing financials. And this is a dividend initiator that's set to grow in the future. And basically, I'm right around my cost basis. This is a position I've just been adding over the past few months. So I feel very good about this position. Stock number 5 is Salesforce, ticker symbol CRM, another big tech company, great financials. I'm up 1.13%, which I'm very happy with considering the recent volatility. So I like this price a lot. And again, this is a new position for mine over the past few months. Stock number 6 is ExxonMobil, ticker symbol XOM. This used to be number 4 in my account, but now it's down to number 6. And that's not because I've sold any of it. And it actually hasn't really gone down much in value. I have a crazy great total return on this though, a 12,300% gain. That's a 218% total return. And this is still my third largest dividend payer. And I'll bring right up here my second largest dividend payer, which is MLPX, my 7th largest position. And I already have a 9.33% total return, and I have not even gotten a dividend from them yet. And then below that, another one of my new high dividend pairs, HESM Midstream. I'm up 3% on that one. Below that, Enterprise Product Partners, which I've owned since 2021 or 2020. I have 116% total return on that. This is also a midstream oil and gas company, but I've been buying HES and MPLX because I actually think they're a little bit better financials, better growth. And then finally, Texas Pacific Land Corporation up the rear, TPL. So for diversification, I have this little bucket of energy stocks, which is around 20% of my overall portfolio. And I wouldn't mind that climbing over time, especially if we get into an opportunistic environment where a lot of energy stocks are on sale. That's one of the things I like about this sector is every once in a while, people just get nutty around it and there can be opportunities. So here you can see my projected dividend income. And one thing I like about this move is not only do I think I'm better set up for a total return from price rise in this portfolio, but now I increased my annual dividend income by nearly $1,000. So now my annual dividends are up to $5,547. The quarterly dividend income is $1,386. Monthly, that's $462. And every day, that's $15.20. And you'll also notice that now my dividend income is much more stable every single month. I used to have a month that was only $90, and that was this month of May. But now that is up to $390. So I increased that 1 month by $300 a month. So I go $390, $389, $607, and then back down. And that repeats because they're all quarterly. And if we take a look at that month of May, that's basically when all my pipeline midstream oil and gas companies pay. And these are all limited partnerships as well. So as I mentioned, MPLX is now my second largest dividend payer with a $765.20 annual dividend. And this is one that I'm just pumped to be reinvesting dividends on, getting that dividend growth. This will be a huge snowball stock for me. And that's the same with stock number 4, HES Midstream, ticker symbol HESM. That's $496 of annual dividends. And I really am just excited to build these up over time, reinvest my dividends, dividend growth, etc. And this month I will be getting my first dividends from them because I bought before the dividend execution date. That'll be $124 from HESM and $191 from MPLX. So every single dividend payment, I'm getting a few shares of each. And my overall earned dividend income is now set to continue growing. And when we take a look at my dividend history, you can see it's changed a lot over time. I had a ton of stocks at the beginning and was more focused on the dividend income. Then I shifted focus towards total return, and I got much more low yield stocks in my portfolio. But then my performance started improving as well. And now I think I'm building this really nice balance of better dividend growth and dividend income mixed with high total return. So this earned dividend history is going to start growing from here and be much more reliable. And another reason why I'm really excited about having more consistent dividend income, for a while, I wasn't really worried about it because I was like, I'm not living off dividends yet. I don't need the money coming in on a specific schedule. But this month of volatility really helped me realize how important it is to have some cash flow coming in all the time. So this dividend income that I'm always reinvesting, it's kind of like a dollar cost averaging approach. You really want money coming in consistently in case we have some crazy volatility like we just had in April. And I would have been kind of pissed if I was in my $90 month when that happened. So I hope you like this portfolio update. One of the biggest changes I've had in a while. And I feel very comfortable with how my dividend growth portfolio is set up to perform in the future. And if you want to view my dividend portfolio and see all my changes as they happen, you can head over to Zach's research on dividenddata.com and you can look at my portfolio with live updated changes. And then if you want to use all the tools I showed on this website, including the portfolio tracking and stock analysis, all of that is available at dividenddata.com. The link is in the description and pinned comment of the video. So with that said, leave a like and subscribe to the channel for future portfolio updates and stock analysis content. Thanks for watching.